All right. Today is March 2nd. Our exam is March 4th at 1:30 in room C208. And Jalen has a couple of questions, so I thought I'd just video it for everybody. Go ahead.
Um, Wait, give me a second.
Sure. And in
So,
the oh, he's got them. All
um,
right.
I know that the I noticed like some of the like stuff that was in the textbook and homework, they're like some of them like aren't exactly on the practice exam. So
Okay.
like
Give me
I
an
was
example.
wondering
Give me an example.
like the posting like the adjusted like entry to like the ledger and like the some of the will we need to be doing that and the post-closing trial balance?
Oh, gotcha. So posting to the ledger, do you mean the T accounts?
Yeah, yeah.
Okay. So we will be, and were they in your book or were they in the practice exam?
They were in the textbook and homework, but I flipped through the practice exam. I don't think I saw it.
Let's bring the practice exam up so we can see it. Come on. Come on, practice exam. Here we go. Okay, I'm going to share my screen. Okay. All right. Can you see this?
Yeah.
Okay, I'm going to make this bigger. All right. So just a quick review on practice exams. If you can, ideally you do it after you've studied, but I know students often start with the practice exam as a form of studying. So the idea is do all of this first and then go to the practice exam, but whatever works for you guys. Okay, so journal entries, lots and lots, 25 journal entries. It's a lot, okay? Um, and then on the practice exam, you you're given a chart of accounts, but you won't be given a chart of accounts on the regular exam, okay? This just gives you an idea of what to study. Okay. And we have adjusting journal entries, room for room for that. We've got the closing journal entries, and then we've got perpetual. So lots of journal entries to know. And we've got periodic and multi-step income statement and some writing. Okay. And calculating the missing amounts and cost of goods sold as well. And then you have more adjusting journal entries. And be sure to watch the dates. They're not always monthly, sometimes they're quarterly. Okay, and prepare the closing entries. And you're right, I don't have I don't have posting them to the general ledger here. So know how to post, know if it's a debit, it's on the left, and it's a credit, it's on the right. Okay. So I typically, so for closing, so let's review the closing journal entries. Just let's bring up the solution. Okay. Because you're here and I might as well. Let's see, this is, yeah. Hang on, here we go. So this is what I like you guys to do for the closing journal entries. So you do your 4 journal entries. Remember, it's 4 closing journal entries, and first thing we do is if there's one revenue account, we debit it. If there's two, we debit each of those revenue accounts. So like you might have service revenue and sales revenue. Okay. So you'd have to debit both of them, and then you credit income summary. And then you credit out all the expense accounts and make one big debit to income summary. And then here you close income summary and here you close dividends, okay? So what I want to show you here is the posting of um, to retained earnings. And I also often will say, hey, post to income summary as well, okay? Hang on, we'll let somebody in. Okay, does that make sense? So here we said the beginning balance. So let's go back and look at the high call. Let's go back and look at the information that they gave us. So let's go look at that. Cole, we're just going over some closing journal entries. Can you hear us?
Yeah, I can hear you.
Okay, great. All right. So here's where we said book the closing journal entries. And look here, you see retained earnings. It has a beginning balance of 2,200. Okay. And then here's the dividend account. It has a debit balance. We only have one revenue account, so that makes it fairly straightforward. 4,300 credit. And then we have three expense accounts. Okay. So then we come over here for the closing. We always close revenue first, then expenses. Okay. And then what I like to do is say, set up retained earnings. Make sure you put in the beginning balance. So here's the beginning balance of retained earnings. Let's see if I can do this. Let's see. Okay. So right here, you'd say, so that 2,200 is your beginning balance, okay? And then here we've credited income summary 4,300. We've debited income summary 4,000. And so what I didn't show here, and I kind of wish I had, is what's the balance in income summary. We only use income summary for the closing journal entries. So the beginning balance is always 0. And then see if I can just put it up here. Can you see Excel here?
Yeah.
Okay, so let's just say we had a T account here, and let's say it's for income summary. Okay, for this problem, okay, just for this problem and for all problems on closing, income summary has a 0 beginning balance. And then if we were to post this credit here, and then the second journal entry, this debit, it would look like this, 4,300 and then 4,000. Okay. That would be the balance. And then entry number 3, we say, hold on, we're going to close out income summary. So we have 4,300, 4,000. So the balance right now, before we do anything, is 300 credit. That means if it's a credit balance at this point in the closing, it means you have profit of 300. If it's a debit balance, it means you had a loss of 300. So now we're going to close out income summary. We're going to debit 300 here. And you can see down here, we credited it to retained earnings. Okay. Now we close dividends. Remember, dividends had a $400 debit balance. So we're going to credit dividends and debit retained earnings. And there's that debit there. Our ending balance for retained earnings is 2,100. Okay. So just be familiar with how these T accounts roll. So at the end, no matter what, income summary has to be zero. It's so temporary. We use it for entries 1, 2, and 3, and then we're done with it and it has a zero balance. Okay. So we use it to close service revenue, we use it to close all the expense accounts, and then we transfer the balance to retained earnings. And you guys did that when you created the statement of retained earnings. You said beginning balance plus net income or minus net loss minus dividends equals ending balance. That's what's happening right here in this T account. Beginning balance plus net income minus dividends equals ending balance. So you're making the T account, the chart of the general ledger, you're making that the same as what you reported on your statements. Income summary, there had better be a zero balance on that T account when you're done, okay? And so that's a way to kind of double check. So then let's look at this. And then we say 4,300 credit, 4,300 total on the debit side. So after we finished with entry number 3, it has to have a zero balance, okay? And the only thing to kind of keep your eyes open for on retained earnings is in chapter 3, retained earnings often had a zero beginning balance, but for closing, it typically does not. It only has a zero beginning balance when you first start out as a company. After that, it always has a balance. So if you go back to the trial balance, here's that beginning balance at the beginning of the year. And then everything below retained earnings, when you are done, it's zero. And everything above retained earnings does not change. But retained earnings new balance is going to be 2,100. Okay. Because we had profit and we paid dividends. So it went from 2,200 to 2,100. And if you want, but it's not going to be required of you, you can run a whole new trial balance. But essentially, everything below this line, retained earnings, is zero. And this is now your updated balance. And you could add them all up again if you wanted and just make sure, but you don't have to. You don't have to do a post-closing trial balance. Okay. Anything else? Let's see, you guys have. So I'm looking at, let's see, hang on. Can you see this Word document? March.
Yeah.
Okay. So calendar financial paper is due March 8th. And then really focus on the journal entries, understand like your ratios, like in this chapter, I want to make sure what they're called. If we did any ratio, I don't think we did ratios in chapter 4. I don't think so. Chapter 5, we did do ratios. We did gross margin. You guys remember how to calculate that? It's net sales minus cost of goods sold is gross margin, also called gross profit. You can do that. And know how to calculate net sales. So let's put this here. Gross margin is equal to net sales minus cost of goods sold. Net sales is equal to sales minus sales returns and allowances minus sales discounts. Okay. And then gross margin percent is equal to gross margin divided by net sales. Okay. So just make sure you know how to do that. Okay. And then the paper is due March 8th at midnight, and it's just one per team. Okay. So how do you feel about the closing? Boy, no voice. How do you feel about the closing journal entries? You guys okay with that? You just start with the trial balance and you do those 4 journal entries. Okay. Okay. Any other questions, specific questions, or I can just do kind of go over what we.
Um, for like interest revenue or like when we gain like interest, does the debit account go to like accounts receivable or like would it be like interest receivable?
Um, it interest is a special case. It would go to interest receivable. Yeah. So like if you said, let's just take one really quick, just for um, go. Okay. Let's say you had a note payable of $4,000 and it's January 1st. And let's say it's due June 30. And let's say interest is 7%. Let's make it bad. Okay. So what would be your adjusting journal entry to record the interest for the quarter ending March 31st? So you have 2 problems here. One is how much is the dollar amount? And the second problem is what's the journal entry for accruing interest? Take a look. So what is it, interest expense or what is it? You remember the journal entry? And you've got 2 days. You got almost 3 days, but no, I guess you only have 2 days.
Is it interest expense and
And then what's the credit? When you owe money, what account do we use?
uh interest payable?
Excellent. Yes. Okay. So you're halfway there. So how do you calculate how much interest you owe?
Uh, Multiply it by 7%, so it would be 0.07.
Okay. And that equals,
280.
okay. And then what? You're doing
Four to
great.
what?
So the question is the 280s for a full year.
Oh,
Interest is always for a full year.
divided by 12.
Divide by 12 and you get what?
23.33.
Oh, what a pretty number. And then what?
Uh, it's quarterly, so multiply it by 3.
Oh man, you're great. Okay. And that is
70.
70, an even 70, right? And remember for my test, don't bother with pennies on the journal entries. If you're doing any kind of a ratio, I want 2 decimals. So like up here, if you're doing a gross margin, use 2 decimals. 42.79%. But if you're doing a journal entry, I don't want the decimal. I don't want the pennies. They're just noisy. Okay. All right. So you're going to do 70 on interest expense. And then 70 debit, 70 credit.
So are you saying like for journal entries, just round to like the nearest whole number?
Correct.
Okay,
Yes. Yeah, absolutely. Okay.
thank you.
So you all have 7 adjusting journal entries. And that's not quite accurate because some of them can be applied to other situations, but I'll go through those. So the 7 journal entries are 4 prepaids and 3 accruals. Interest is an accrual. So the prepaids mean that at some point there was an earlier thing that you bought or revenue that you earned, and now you're just using it up. Okay. So the first example is the supplies one. Second example is prepaid insurance. And the reason I say 7 but ... is what could be prepaid insurance. The same idea is used for prepaid rent. Okay, but we don't say there's 8 adjusting journal entries because those two are kind of the same. Prepaid rent. Then we say depreciation. Then we say unearned revenue. Okay, that's the prepaids. Okay. Then we get into the accruals. And those are going to be accruing revenue, accruing interest, which you guys did above, and of course, salaries and wages. Okay. Now you could also have, let's just put them here. You could also have other types of accruals. You could say, I got a bill for utility expense, but I haven't paid it yet, but it's in the past, so I have to record that revenue. So it would be debit, utility expense, credit, accounts payable. But these 7 are just like really common examples, so we use them. 1, 2, 3. Oops, messed that up. All right. Okay. So do you remember the journal entry for supply? So none of these journal entries have cash in them. No cash in adjusting journal entries, ever, ever. So do you guys remember the journal entry for supplies, for prepaid insurance, depreciation? This is just the adjusting journal entry. So what's the adjusting journal entry for supplies? What do you do?
So,
Go ahead.
so debit supplies expense and credit supplies.
Right. So we buy the supplies earlier. We put the supplies in the stock room, and then we keep pulling supplies out, and then we count the supplies at the end of the month, and we say, oh, we must have used these up. Debit supplies expense, credit supplies. Okay. Do you know what it is for prepaid insurance or prepaid rent? So here we do the same thing, insurance expense. So I want you to notice that these 2 and the third one, these are asset accounts. And where do asset accounts live? Income statement or balance sheet?
Balance sheet.
So we put something on the balance sheet. So it increased our assets and now we're using it up. So the asset goes down and we're recording it as an expense on the income statement, which makes our costs go up and our net income go down. But that's the cost of doing business, right? Now, depreciation is different because it's for equipment. We leave equipment on the balance sheet as it is, and we do it differently. We still debit depreciation expense. That's similar to what you've been doing. But now we credit a new account, accumulated depreciation. Okay. Can't spell today, but take it. Oof, that's not the right word either. Okay. And accumulated depreciation is a credit balance, and it's a contra account, and it rides right next to equipment. So the equipment T account has the full value of the asset, but the accumulated depreciation account tells you how much has been written off. It's accumulated, all the write-offs. And then so you can look and say, oh, we bought a piece of equipment for 10,000, but the balance in accumulated depreciation is 8,000. So it must be pretty old, right? And the net book value of that asset is 10,000 minus 8,000 or 2,000. Okay. So these are all asset accounts. And now, we don't see the equipment account here at all because we leave that separate. Okay. But the asset is equipment. Now we've got unearned revenue, and now we're dealing with a liability account. Even though it has the word revenue in it, it's a liability. Okay. So the adjusting journal entry for this is debit unearned revenue and credit service revenue. So why do we do unearned revenue? Again, there's a prepayment where the customer prepays for something and they say, hey, we want to rent out your golf course, right? We want to rent out your golf course for a company event. So we'll give you $5,000, and 2 months from now, we'll rent the golf course out. When we rent the golf course out, the golf course company debits, it's got 5,000 in that T account, right? The T account on the credit side. Now it says, well, we've earned the revenue. We're going to report the revenue. So we get rid of this. We debit it and we credit service revenue. Now sales go up, profit goes up. So the Mariners, the Seahawks, they're doing this all the time. How? With ticket sales. You buy a season ticket, they put that money in unearned revenue, and then once a month, they have to recognize the revenue for all the games they played for people who bought season tickets. Okay. Okay, these guys down here are simpler. There's not really an original entry, but you're just accruing something that you've expensed. So service revenue, you guys did this really early on. You debit accounts receivable and you credit service revenue. What are the facts around that? You say, we perform the service. We haven't billed the customer yet. We haven't recorded the journal entry yet, but we want to make sure we get it into the month of January or whatever month we're dealing with. Okay. And I can tell you, working in industry for 4 different companies, presidents of companies are very interested in whether a company has recognized all the invoices, all the revenue. Have we recognized all the revenue? Isn't there more revenue? Okay. And then interest, we just did that above. Interest expense, interest payable. I'm going to let Nabil in. And then salary and wages. That's a little trickier. You guys have to calculate that. But the journal entry is pretty straightforward. Salary and wages expense, credit, salary. Hi, Nabil. And wages.
Hi, how's it going?
payable. Doing good. I am videoing this, just so you know, just a little test review. Okay.
Okay, no worries.
So what are we doing with these 3 journal entries? We're increasing sales here. That's great. We have so all the adjusting journal entries have to have at least 1 balance sheet account and 1 income statement account. Okay. So going up here, Supplies expense is an income statement account. Supplies is a balance sheet account. Insurance expense is an income statement account. Prepaid insurance is an asset, it's balance sheet. Depreciation expense is an income statement account. Accumulated depreciation is that contra asset, balance sheet. Unearned revenue is a liability, balance sheet. Service revenue credit is an income statement account. And then down here, we've got balance sheet, accounts receivable, and service revenue. So when we say, hey, we made a sale, we haven't booked the journal entry yet. So we debit accounts receivable. We've increased assets. Eventually, we'll increase cash. But right now, we're increasing accounts receivable and we're increasing sales. Here, we're increasing a liability. We owe this interest here. And then this is your income statement account, interest expense, salary and wage expense, income statement account, salary and wages payable liabilities. So a lot of the accruals tend to increase liabilities. But if you can accrue revenue, that's good too. So you have the revenue to go against it. But really know these 7 journal entries. So the big calculations are going to be on depreciation a little bit. Interest, you're going to have to calculate the interest owed, and then salary and wages, how much salary and wages do you owe as of the end of the month? So, and the salary and wage one, if you look at your practice exam, let's go look at those. Can you see this? Lock Free pays its employees $10,000 every Monday for the preceding Friday, the 5-day week. On Monday, employees were paid for the week. All employees worked the last 3 days. So that would have been December 29th, December 30, and December 31. And if you guys zone out and forget how many days in a month, just ask me in the middle of the exam. Don't feel like you can't ask that question. Exam stress sometimes makes you forget things. So they've paid him through the 26th, but the employees worked an additional 3 days. So that journal entry, salary and wage expense, salary and wages payable, has to reflect 3 days of work. So what is that going to be? What's the total going to be for that for 3 days? And I'm going to run and get some water. I will be right back. So see if you can come up with that number. If you want, you can direct message me in the chat. Tell me what that number is for those 3 days. Jalen, you are correct. Anybody else? So we go back here, take a look. And should say salary and wage expense. So you get the 6,000. So they earn 10,000 a week. Divide by 5 is 2,000 a day times 3 days. And there's your 6. Okay. All right. What else can we go over? Let's see.
I had a question about something.
Yeah, go ahead, Cole.
It was kind of it was like the last like homework question, the one that was due on Sunday. I think it was a multi-step income statement, and it was
Sure.
like under like the periodic system. I was just kind of confused because I thought that it would be like kind of similar, but I don't know. It was different from how you like do it under the other system.
Let's take a look. Let's go look at it.
I don't know, it kind of threw me off because like I get how like the different systems like there's differences with like recording
Mhm.
like the journal entries, but that part, yeah, I don't know, it's confusing.
Let's take a look. I'll just bring it up. And it was homework part two, right? Last night.
Yeah, the part two one.
So it will be only periodic.
Mm-hmm.
Okay, let's see. Do you remember which one?
Yeah, it was the problem five. 'Cause there's like
5-9.
multiple parts, but I understood everything. It's just once you get to like the multi-step income statement.
So you got down here, and then here's all your accounts,
Mm-hmm.
and then here's your trial balance.
Yeah.
And you have these accounts, purchase, purchase return, purchase discount, and freight in. Okay.
Mm-hmm.
All right. I am back. Can you guys hear me? Says it's still recording.
Yeah, I can hear you.
I thought I stopped the recording, but I think it's still recording.
It said it stopped when you left, and then it just said started again.
Okay, maybe because I came back. Okay, awesome. All right, so let's look at this. So your question is about the income statement.
Yeah, because like I don't know if I just couldn't find it. I was look in the textbook. I was trying to find an example like under like the periodic system, but
Sure.
I couldn't find one.
Okay, so what I want you to know, so can you see Canvas right now?
I cannot.
Okay, because I'm not sharing my screen. Okay, here we go. All right. So what I want you to do, so let's look at the textbook. Can you see the Canvas now?
Yeah.
Um, so we're going to open the textbook. This stuff down here is not your textbook. I actually find that kind of misleading for students. But anyway, this
Hmm.
is your textbook. And we're going to go chapter 5. So I want to first look at the multi-step income statement
Hmm.
for perpetual. That's
Hmm.
the one that we do mostly.
Yeah, because I tried to look it up. Like it's like I get doing it for perpetual, and I think it said that like the other one it wants you to do the calculations on the sheet or something.
Mhm. Okay. So this is the single step, but now we want the so you it's a little bit tiny here, but the reason it's called multi-step is because you have steps and the steps
Hmm.
are subtotals. So the first
Hmm.
subtotal we have is gross profit. Second subtotal we have is operating income or income from operations. And then the last step is income before tax and then net income. Okay.
Hmm.
So here is super easy if you have a perpetual income statement. Now you might have 3 lines of sales. You might have sales, sales returns, sales discounts. That's fine. You'll have to do
Hmm.
a subtotal for net sales. Okay. Now we go, well, how does this look like for perpetual? And what they did to you is they said, let's just go look. So they show you the journal entries. By the way, I love this. It's a side by side of both the perpetual and the periodic journal entries.
Hmm.
Super, super helpful. All right. And where is it? It's somewhere. I'm gonna find it every time. Let's see. I gotta find it. Hang on. There is an example in your book. It's just a little hard to find.
I don't know. It's like everything else in this chapter like made good sense to me, but it was like that question. There were just so many boxes I didn't know what to do.
And you don't need to know that for the test.
Mm-hmm.
Um, you need to know, this is what I'm going to tell you. You need to know how to do a perpetual multi-step
Mm-hmm.
income statement.
Okay.
And the only difference is how we calculate cost of goods sold. So here it is.
Mm-hmm.
It's illustration 5.14 in your book. Okay, so you can see cost of goods sold here. Okay, you
Mm-hmm.
need to be able to do this calculation. The rest of the income statement is identical to the multi-step income statement for perpetual. Okay.
Mm.
So I don't test you on doing a multi-step income statement for periodic. I want you just to know how to do the cost of goods sold part. And that is what is on your practice exam.
And
The
that's because
cost
that's
of
like the
goods.
only different part.
That's the only different part. Yeah. So, and this should feel a little bit like the supplies account.
Mm-hmm.
You had cost of goods sold, you're calculating it. You start with beginning inventory. You make purchases, that's an add. And then down at the end, you subtract your current inventory.
Mm-hmm.
And the difference tells you what was cost of goods sold. Or for supplies, it tells you what was supplies expense. So there's 5 things here. 1, inventory. 2, purchases. 3, purchase returns and allowances. 4, purchase discounts. And 5, freight in. Net purchases is just a calculation. So you add up those 5 things and you get this number. Goods, goods available for sale.
Mm-hmm.
Okay. The beginning inventory plus all the action with purchasing is 356. Then you subtract ending inventory and then you get cost of goods sold. Okay. So when you're calculating this, I don't really care about the subtotals up here.
Mm-hmm.
I just say add up those 5 things and get goods available for sale, then subtract ending inventory, and you have
So
cost.
like on the exam, you could kind of just do it like it is on the far right. Is
I
that what you're
would
saying?
put not quite. What I want you to do is put in all the elements. So
Mm-hmm.
here you'd say, let me show you what I want. And you can do it like this too. Honestly, you can. So this would be what I would want to see here. Let's see if I can move this guy over a little bit. Okay. So cost of goods sold. So I would want you to show beginning inventory plus purchases minus purchase discount okay, then minus ending inventory
Mm.
equals, okay, I don't need any subtotals in there.
That's what you want. Okay.
So you could do it like this. You could say 36,000 minus 10,400 minus 68. Oops, I think I did that wrong. 36,000 325,000 minus 68 plus freight. And then you'd add all those 5 things up, right?
Mm-hmm.
And you'd get. I can always suspect that 356, okay? So there's your 356 there.
Mm-hmm.
Say, oh, minus ending inventory. We haven't sold ending inventory yet. And then 316. Show me your work. Don't give me one number. I'll tell you why.
Mm-hmm.
Because I can't give you partial credit if you make a mistake, if you give me
Yeah.
one number. Okay. But if you just lay that out, that's real clear. I don't need all these
The
subtotals.
weird down slant.
Where do you see that?
What was that?
What did you just say?
Oh, I was saying like you don't need like the weird like down slant, how like it goes off to the right.
No, no, no.
Okay.
You do not, you definitely
Mm,
don't need the weird
mhm,
down slant. Gotcha. No, I actually find that annoying. It's a
mhm,
little too, if you go look at statements out on the SEC website, they don't do all of that stuff.
mhm.
It's too distracting, even,
Yeah.
so you don't see it on the SEC. That's fine. You don't even see it inside companies. You don't see all that indentation. People get used to the data in one column and it's fine.
Yeah, I don't know why. Yeah, because it just threw me off because I knew like the formula and everything and how like you get like cost of goods sold, but when it was all like that, I was trying to just figure out where to put
You
everything, and I don't know.
don't get hung up on that. It's I guess it helps. It sort of shows you how things are added up, but in
Mhm,
practice we just don't do it. And I think over the years I think it just confuses students more.
mhm.
Okay.
And then I guess I had one more kind of quick question.
Sure.
This was kind of related to the project because I just finished my part. I'm doing like a part four where like I'm writing on all the income statements. And I was kind of just wondering, I didn't know like if I don't know if like I'm doing like it like I have too much information or too little.
And let's take a look at the instructions. I know I got a couple questions today, and what I was seeing was the students were actually putting more than I really wanted. Let's see, project part two.
Then yeah, that might be me then. I don't know. I think I'm at like I tried to keep it like really like not like I don't know, just like the main stuff, but I don't know. I think I was at like 800 something words.
That's probably too much, Cole.
Really?
So,
Okay.
so here you are. You guys have given me your financial statements, right? You've made your project plans, and now this is your project. Title, brief intro, your spreadsheets, and now you have
Hmm.
one page for income statement, one page for balance sheet. Okay.
Hmm.
And for your format, let's go past these guys. So sorry, let's go back here. Here's your income statement,
Hmm.
sales, gross profit, net income, and this is what we call a horizontal analysis, 3 years running. And then here we're doing 3 years of key ratios, gross profit,
Hmm.
net income, and so forth. And then balance sheet, we have a lot of balance sheet items, and then current ratio, working cap, and so forth. So on your income statement page, start with sales, always start with sales,
Hmm.
then net income, growth rates. Okay. Finally, discuss gross profit percent, and then you're done
Hmm.
above. You don't need to
Yeah.
discuss every item there. Then discuss the ratios, gross profit percent, net income percent, EPS, and days inventory on hand. You don't need to discuss inventory turns and days inventory on hand. Just
Oh,
just
okay. I
one.
did both.
Yeah, you don't need to because it's the same thing. It's just a different way of
Hmm.
looking at the same data. On your balance sheet, always start with assets. So you're basically going from the really big general to some specific.
Hmm.
How are liabilities doing? Do we
I
have a lot
guess
of growth there? And then you go jump to the ratios.
I guess some like I don't know like for example, I guess because like sales like that's what like you like I started with and because it said that, but like because I talked about like the kind of the jump between like every year, like it for like almost everything like that I was going over. Like I would look at like
The growth
the
rate.
trend from year to year,
Mhm.
how it changed, like what it was doing. Like is it, like am I supposed to do that or is that like going too like far into it?
You're going to do that with sales and net income, but you're talking down here when you get into the ratios.
Yeah.
So for the ratios, we don't show growth rates here. We,
Hmm.
we just show the basics. So you're really talking, so let's go to income statement. So up here, I'm saying, give me the growth rates in those big
Hmm.
numbers, sales and, whatever. Down here, you're really looking, are we maintaining our gross
Hmm.
profit percent? Because if we're not, what's going on? That indicates that you're either putting a lot of stuff on discount
Hmm.
or your costs are going up. You don't know. You don't have to find out as a writer, but you have to say, hey, it looks like they're not controlling cost, or they're having to, if you have a lot of competition, you have to lower your selling price,
Hmm.
which is going to make your gross profit go down if your costs don't change. So let's say you bought something for $7, you sell it for 12. So
Hmm.
your gross profit is 5, or 5 divided by 12. Okay, if you want the percent. If all your competitors are selling for 11, you're going to have to start selling for 11 unless you
Hmm.
can differentiate your product from theirs
Yeah.
and say, oh, we're better because of this. But let's say you can't. So year one, you'll have a profit of $5 divided by 12. You'll have a profit of 42%, 41.67. But if the company lowers its selling price, they're going to have a profit of 36.36%. So that's what I'm talking about. Oh, they used to have a gross margin of 42. Now they have it at 36. It looks like
Hmm.
their costs are going up or their sales are going down, something like that.
And I guess that's whenever there was certain things like that, like should I only be talking about the numbers or should I be trying to explain like if like how you're saying like if there is a big change in gross profit, should I say like why that could be?
You can speculate,
Hmm.
or you can just be very general and just say
Hmm.
this is cause for alarm. They've slipped. And so let's say this was, I'm just going to put this in 42.37, 40.29, and 39.88. Okay, let's just say that was the pattern there. Can you guys see that?
Hmm.
Okay. So you'd want to address the fact that the gross margin is slipping.
Yeah.
So you'd say this is an unfavorable trend. It looks as though they have been losing ground in their gross margin, cause for alarm. You could
Hmm.
speculate because we know gross profit is sales minus cost of goods sold. You could say, looks like they have some cost issues, some rising
Hmm.
costs, which makes sense, right? We're all in this time of inflation.
Yeah.
Um,
But
Go
you
ahead.
wouldn't say from 2023 they went from 42 to 0.37 to 40.29 and then from 2024 to 2025 they went like you don't have to do that every time because I kind of did and maybe that's why I have so much is like I don't know everything I like talked about every year and like the change.
How many sentences? You want to just show me what you did? How many
Yeah.
sentences do you have for gross margin?
Let me look real quick. Okay. For that, because I put all the percentages into one paragraph, but
Let's see, stop sharing. Let me make sure you can share. Jalen, do you have other questions too? I want to make sure I'm addressing your questions while he's pulling
Oh,
that up.
I just had like one more quick question, but it was just like the journal entry for like the third line. Would we need to like specify like what, why we're
No,
like,
no
oh,
descriptions
okay.
on the exams. It takes too long for students. So yeah, thanks for asking. Can you remind me to announce that tomorrow? It's on your instructions, but
Oh, okay.
okay. Mixed but stable. So go to your ratios.
so yeah, this is like all the ratios. This is for Home Depot.
So the trends present are constant with only minute. You might want to check this spelling. It's not minuet. So
Okay,
gross
I
gross
haven't.
profit, it's fine. Don't worry about it. Gross profit was 33, but dropped. So okay. So when you calculated that 0.15%,
Hmm.
I wouldn't say that. I would say, but dropped two, and I'd list the new one there.
Okay.
Um, the reason being is it's not really a percent. It's what we call, or you could say, instead of that percent sign, you'd say drop 0.15 points.
Mm.
Because percent means you took this year minus last year divided by last year, and you just subtracted, right?
Yeah, yeah. I see.
Yeah,
So that
no,
you're
so
saying
it's
that's
not a
not like a
percent. Yeah,
percentage.
yeah. Just say points. Yeah. Whenever you're doing a subtraction between two percents, we don't say it dropped X point, a percent. We say it dropped X points. Okay,
Okay.
this was followed by an increase of 0.04 points. And I think I would just put the in 24. I think those are pretty small. I mean, they're not the 015 is not good, but the
Hmm.
014 is not bad. Um, and you're saying increase and decrease.
I guess because yeah,
I
for
want to know
this,
if it's good news or bad news. So
okay,
you're
because I
so you said that above about something. You said it's stable. So the
mm,
trends in gross profit are had minute fluctuations, but are trending down a little bit, or with
mhm,
some unfavorable. Gross profit was 33.53, but dropped unfavorably 0.15 points. Just be really clear it's unfavorable and
mhm.
improve slightly. Don't try to avoid saying increase, decrease. You can say improved or declined. So we know it's
Okay,
bad news or good news.
okay.
Overall are very stable. The trends seen net income percent are unfavorable with declining rate. Good. It was 10.3, which dropped to 9. Oh, I like that sentence. And I wouldn't worry about the change of 0.95%. If you're either
Hmm.
try to keep your writing consistent for each line. So you're saying, I, I wouldn't worry about the net change for the ratios. I would say it dropped to whatever the new ratio is, and
Hmm.
then it
Okay.
recovered slightly to this ratio. I think it reads better.
Hmm. I'm going kind of too deep into it when it's not that big of a deal.
Well, I think the net change is interesting, but I think it's making people do a calculation. So what is the ratio now? What is gross margin now? You're not telling us. So just go ahead and tell us what it is.
For like what year?
Yeah, so
Because
go back to your first. Gross profit was 33.53 in 22, but dropped to what in 23?
oh,
What?
to 33.38.
Sure, that's good.
Mm,
But dropped to 33.38 in 23. This was followed by a slight increase to the final number in 24.
mm.
I wouldn't focus on the net changes.
Okay, I
So
see.
these, and then you're adding, so that's your first sentence about gross margin. And you're saying stable, strong pricing and cost management. That's fine.
Mm,
Net income percents are unfavorable. Net income percent, which dropped to 9.92. That's good. I wouldn't do a change of 9.5, just leave it out. And then I'd just keep that all one sentence and finally drop to 9.28. I just clean it up a little, less
okay,
words.
I see, I see.
Um, all right. Did
Yeah,
you
that makes sense. I see. I think I just need to kind of cut it down a bit.
just cut it down a little bit?
Mm,
It's going to be easier to read. So
mm. And then take out oh yeah, take out the inventory turnover, right?
yes, take it out. Just
Okay.
give me inventory turnover. I mean, I think or days to collect. I think days to collect people understand them more. So
Hmm.
that's what I would go.
Okay, well, thank you so much for your help. That
All
because
right,
I
you
kind of
take care.
knew I was a bit over. I need to cut it down. So like, because I know there wasn't like a word requirement. But if you had to kind of guess, like, how many words should I be at?
So typically we say, let's go back to the instructions because I think they're helpful. Can, can you, oh no, you can't see this. Hang on. Stop
I
share.
can see the.
Oh, you can't? Oops, okay.
Mm-hmm.
I've got like two screens up. All right. Okay, so I'm saying keep it to one page for the income statement. Sorry, let me go back. Here we go. Keep it to one page for the income statement, one page for the balance sheet. A
Hmm.
typical page is like 250 words, double space.
Oh
So
wow, so I should be around there.
Yeah, yeah, you don't need it to
Dang,
be zero.
I need to take out a lot then.
Yeah, slash. Whew, yeah,
Hmm.
less is more. So,
Okay. Okay, sweet. Well, thank you so much. I
all right, you
appreciate all the
take care.
help.
We'll see you on Wednesday.
Yep, have a great rest of your day.
You too. Bye bye.